The much-awaited budget from a government that's got a superb political majority is finally out, and I can look at least 7 very important key takeaways. One, it's a growth supporting budget, and I'll tell you why. That's because it's giving a 70,000 crore capital bonanza to the public sector banks. No one expected that, and therefore one should expect easier bank lending. So the liquidity tap is kind of open. And then there is this troubled NBFC sector. They were not lending. That's my second takeaway. The NBFCs get some kind of relief in the sense that if banks lend to them and they suffered a loss, the government is willing to backstop it, absorb that 10% of that loss. As well, Reserve Bank has also chipped in with some concessions if loans are given to NBFCs. That's the second takeaway, a second tap opened for growth. A third tap opened for growth is the cost of borrowing has come down in the market. Because the government has stuck to the fiscal deficit and because of some external borrowing, the cost of the 10-year loan for the government of India, which was 6.9% just last week, is now 6.6%. So that's had a salutary impact. When government borrows cheaper, all corporates can borrow a little cheaply. That's the third takeaway. The fourth takeaway, you want to believe this fiscal deficit number a little more than you want to believe previous numbers because the assumptions are not so fantastic. The interim budget, if you looked at the numbers, the assumption of tax growth was 30% almost, 29%. Now the assumption of tax growth is 25%. Still a little fantastic, but at least a little more credible. To be fair, they're also getting more sources because they have taxed petrol and other items a little more. So it becomes a slightly more believable number, higher dividend from RBI, higher divestment assumptions. So a more believable fiscal deficit number, a more believable fiscal math. Takeaway number 5, they are chasing the rich. This is usually what governments do when they have to find money. So if you're earning more than 2 crore and more than 5 crore, your tax payments go up. The surcharge increases by 3% in the first case and by 7% in the second case. Also, you have to pay more for petrol and diesel, 1 rupee excise increase. So again, that's what the rich will crib about. Takeaway number 5. Takeaway number 6, this is big as far as I'm concerned. Government has decided to borrow for its fiscal deficit purposes from abroad. For the last 40 years, Indian governments and the central bank, that's the Reserve Bank, have refused to do that. They decided to change now. It's a bit worrisome, but at the moment, the bond markets are happy because part of the burden is going abroad. It could be a long-term worry. We'll leave it at that. And finally, the takeaway number 7, the real reason why the stock market fell after the budget, promoters who own companies have to list at least 35% of the shares in the market. Until now, the minimum shareholding was 25%. So, Tata Sons, for instance, they have listed only 25% of TCS. Tata Sons owns the remaining 75%. Now, Tata Sons can own only 65%. They have to list another 10%. This may be very good for all of us because more good quality shares are coming. But the point is there will be a sudden supply of paper. This is not happening tomorrow. They are in consultation with SEBI. It will take time. But that takeaway number 7 is what has made the stock market sulk. Overall, I would say a growth supportive budget. So those are the 7 key takeaways from the budget coming to you from Always You First Budget, supported by CNBC TV18.com and IDFC First Bank.